Hey everyone, welcome back to Corporate Decoder, the place where we decode the murky world of corporate finance. And today we're diving into an S-1 filing from Brava Acquisition Corporation, a SPAC that is looking to find its perfect match in the business world. Get ready for a financial roller coaster with a side of risk because this is a blank check company, and that comes with its own unique set of challenges and opportunities. Before we get into the nitty-gritty, if you love getting the real scoop straight from these regulatory filings, make sure you hit that subscribe button. And hey, we have a fantastic community over on Discord. Links are in the description below if you want to chat more about this and other company deep dives. Alright, so Brava Acquisition Corp is a freshly minted company from the Cayman Islands, and like all SPACs, their main mission is to merge with another business. They have not yet picked a target, so we are looking at a company that is essentially a pot of money waiting to be invested, which is always a wild card. They are looking to raise about $75 million by selling units at $10 each with an option for the underwriters to buy more. Each unit is a package deal, one share, and one right to get a fraction of another share later on. It sounds simple, but remember this is all before they find that business combination. Now here is where things get interesting. Their sponsor Brava Capital Management LLC is buying a chunk of these units too, but in a private deal, not through this public offering. They are putting in around $2.25 million for 225,000 units. This shows commitment from the sponsor, but also raises questions about potential conflicts of interest, which we will get to. This next number is a huge red flag for any potential investor. The sponsor bought founder shares for practically nothing, about 9/10 of a cent per S-hair. This means that as soon as the public offering closes, existing shareholders will experience significant dilution, meaning their ownership stake in the company effectively becomes smaller compared to what it was before. Warren Buffett always says understand your cost basis, and here the sponsor's cost basis is incredibly low, setting up for a massive potential profit, even if the company's stock price tanks after a deal. Let's look at some dilution numbers, because this is where you see the real mathematical impact of that low sponsor share price. This table shows what is called net tangible book value per S-hair. After this offering and considering all the shares issued, the net tangible book value per S-hair is startlingly low. Look at this assuming the underwriters fully exercise their option to buy more units at the public offering price of $10 per unit. With no redemptions by public shareholders, the net tangible book value per S-hair is only about $7.18, assuming they fully exercise the over-allotment option. And if the underwriters do not exercise their over-allotment option, it drops slightly to $7.16. Now here is the kicker, the dilution to public shareholders. Assuming the full exercise of the over-allotment option and no redemptions, the dilution is about $2.82. Per S-hair, that is a real hit to your investment value right from the start. And as a percentage, that is over 28% dilution. Now if we look all the way to the maximum redemption scenario where almost everybody wants their money back, then with the over-allotment option, exercise, that dilution skyrockets to almost 98%. That means your $10 investment is effectively worth barely 25 cents in terms of tangible book value. That is a massive dilution, and something potential investors must really pay attention to because it highlights how much the sponsor's cheap shares impact the public investors. Remember that sponsor commitment. Well, those 225,000 units are being bought for $10 each. That is a $2.25 million investment. While it seems like a lot, it is important to remember they only paid about 9/10 of a cent for their founder shares, meaning their actual profit potential is astronomical, even if the company performs poorly after a merger. These founder shares are a big deal. They convert into Class A ordinary shares 1-for-1, which sounds fair, but the anti-dilution clauses are key. If the company issues more shares later for a business combination or other reasons, the conversion ratio for these founder shares can adjust, meaning the sponsor could end up with even more shares, diluting public shareholders further. It is a bit of a golden parachute for the sponsor. Let's meet the team running the show. Sean T. Rooney, the CEO, has a background in oil and gas, especially in Latin America. Peter Lawrence Giannulis, the CFO, brings experience in global capital markets and private equity, and Carlos Andres Barresi, the chairman and CEO, has a deep dive into food and agriculture in Argentina. They also have independent directors Eduardo Jose Esteban Federico Luis Guerrero and Rupert Stebbings. Their experience is quite diverse, but it is important to remember past success does not guarantee future results. Brava is looking for businesses with an enterprise value between $150 to $250 million, focusing on the food production and agribusiness sectors, primarily in Latin America. They want companies ready for growth with strong fundamentals and leadership. They are particular about companies with international exposure to mitigate currency risk, and they are looking for market leaders or top-tier players. This specific focus is good. It narrows down the field, but also means they might miss out on other opportunities. Now for the really juicy stuff, the risks, and this document is packed with them. One major risk is that public shareholders might not get a vote on the business combination. Even if there is a vote the sponsor's shares get a say to, meaning a deal could go through, even if most public shareholders are against it. Essentially, as a public shareholder, your main power here is to cash out. If you don't like the deal, you can redeem your shares, but this redemption feature can scare off potential target businesses who worry about not having enough cash after redemptions. We've touched on this, but it is worth repeating that incredibly low price the sponsor paid for founder shares means they stand to make a fortune, even if the stock price crashes after a merger. This creates a powerful incentive for them to get any deal done regardless of its long-term success for public investors. It is a classic SEACA Zima. There is also the risk of getting kicked off NASDAQ. If they can't meet the listing requirements, it could severely hurt liquidity and make it harder for investors to sell their shares. And the big one, if they don't find a business combination partner within their designated timeframe, which is 18 months extendable to 27 months, they have to return the money in the trust account to shareholders. Your investment basically evaporates and those rights you got with your unit become worthless. Financially speaking, as of September 2025, the company has no revenue and a net loss of just over $30,000, mostly from formation and administrative costs. This is expected for a SPAC before a deal closes, but it highlights their dependency on the offering proceeds. Their total shareholders deficit is negative about $5,700. Again, this is typical for a pre-IPO SPAC. The financials really just show the setup phase. The real story will be written after they merge. The auditors Crate and Chew CPA LLP issued a standard report, but importantly flagged a substantial doubt about the company's ability to continue as a going concern. This is a formal way of saying they're worried the company might run out of money if this offering doesn't go through. Basically, they need this offering to survive. One interesting detail is a promissory note from the sponsor for over $34,000. It is non-interest bearing and basically covers early expenses, showing the sponsor fronting some cash to get things moving. This note will be repaid from the offering proceeds. To stay listed on NASDAQ, they need to maintain a market value of listed securities of at least $50 million and have at least 400 public holders. These are standard requirements, but if their stock price plummets after a merger, they could fall short. So what is the verdict on Brava Accession Corp? They're a SPAC with a clear strategy focusing on Latin American food and agriculture. The team has solid experience, but the huge dilution from the sponsor's low-cost founder shares is a major concern. The company absolutely needs this offering to go through to fund its operations and find a deal. The going concern warning from the auditors is a stark reminder of their current precarious financial footing. If they find the right business at the right price and can navigate the inherent risks of a SPAC, then maybe there is potential. But the odds are always stacked against SPACs, especially post. Merger so that low sponsor share price and the resulting dilution keep me cautious. Alright, that is our decode of Brava Accession Corp. S-1 filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.